This video discusses top 10 IT frauds you didn't know about. Before watching, like and subscribe to our channel. Most occupational fraudsters have clean employment records, according to the ACFE's 2012 report to the nation. 84% have never been reprimanded or fired for fraud-related activity. Number 10. Satyam. This India-based IT firm inflated revenue, margins, and cash balances to boost earnings by $1.5 billion. Ramlinga Raju admitted fraud to the company's board of directors. They were charged with breach of trust, conspiracy, cheating, and record fabrication. The FBI didn't file charges in time, so both were freed. Raju writes to his board, what started as a small disparity between actual operating earnings and those in the books of accounts grew over the years. It's uncontrollable. Later, he compares it to riding a tiger without understanding how to get off. Number 9. Bernie Madoff. Madoff's Wall Street investment business ran the largest Ponzi scam ever, stealing $64.8 billion. Instead of profits, investors were compensated with their own or other investors' money. Madoff confessed to his sons, who turned him in the next day. Madoff refused to replace the 1980s IBM AS/400 computer that stored the bogus material. We understand. Jeannie says, when things are too good, something's wrong. This didn't simply harm wealthy investors, adds Green. Grandma's life savings were stolen. Number 8. Lehman Brothers. This bank went bankrupt after hiding $50 billion in loans as sales. Lehman sold toxic assets to Cayman Island banks with the intention of buying them back. Insufficient evidence prevented SEC prosecution. Green, frauds grow exponentially. Lehman was a perfect case of I need to declare $20 million. To make up for the $20 million shortfall, I'm temporarily robbing from the future. Next quarter, I'll compensate. Etc. Number 7. American Insurance Group, AIG. This global firm committed $3.9 billion in accounting fraud, bid rigging, and stock price manipulation. It and numerous pension funds settled with the SEC for $1.74 billion. Hank Greenberg was fired but not prosecuted. Greenberg allegedly classified loans as revenue, pushed clients to insurers with repayment obligations, and inflated stock prices. Green calls bid rigging a clever but prevalent deception. There have been red signals for years. A diligent auditor can notice this deception. If you think you'll get away with it, guess again. Number 6. Freddie Mac. A 2003 SEC report said this federally backed mortgage giant overstated earnings by $5 billion. The company's CEO, CFO, and COO were sacked and fined $125 million. The settlement forced Freddie Mac's board to alter its bylaws, meeting frequency, and standards of behavior. The board was also mandated to limit member terms. Freddie Mac was obligated to report on its internal controls and internal audit strategies. Separating CEO and chairman was essential. Green argues federal funding increases regulation. Pay attention and do well. Number 5. HealthSouth. This healthcare corporation exaggerated earnings by $1.4 billion to please investors. CEO Richard Scrushy allegedly fabricated data and transactions from 1996 to 2003. Pre-tax income and cash balances were overstated. The SEC became suspicious when Scrushy sold $75 million in stock before a big loss. Scrushy was acquitted of all 36 accounting fraud allegations despite 5 top executives pleading guilty, including the CIO. He was convicted of bribing Alabama's governor and sentenced to 7 years in jail. Scrushy is an innocent motivational speaker. Number 4. Tyco. In 2002, the SEC targeted this New Jersey-based Swiss security systems company for questionable accounting techniques that inflated company income by $500 million and paid the CEO and CFO $150 million. Unapproved loans and illicit stock trades were camouflaged as executive bonuses and benefits. CEO L. Dennis Kozlowski and CFO Mark Schwartz got 8 to 25 years. A class action lawsuit cost the corporation $2.92 billion. Kozlowski threw his wife a $2 million party on a private island with a Jimmy Buffet performance. A corporate study highlighted his $14 million in Fifth Avenue repairs and redecorating with company monies. $6,000 shower curtain and $2,200 wastebasket were among the most ludicrous. Number 3. Enron. Houston's commodities, oil, and service company hid massive debts. Shareholders lost $74 billion, thousands of employees lost their retirement plans, and more lost their jobs. Sharon Watkins blew the whistle when high stock prices suggested impropriety. Arthur Andersen was implicated. CEO Jeff Skilling got 24 years. Kenneth Lay didn't serve time. Former CFO Andrew Fastow, who pled guilty to 2 charges of conspiracy, said, "Some people look at the restrictions and find methods to structure around them. Complex rules increase opportunity. I should have inquired, what is the principle?" Number 2. Waste management. This Houston-based public corporation allegedly declared $1.7 billion in fake earnings by inflating the depreciation length for their property, plant, and equipment. SEC charged a 5-year scam in 2002. The company's new CEO settled a shareholder class action suit for $457 million and set up an anonymous hotline where employees could report dishonest activity. SEC says CEOs committed this scam. Philip Rooney, president, prevented required write-offs and rejected accounting judgments that would hurt operations. He gained more than $9.2 million illegally through performance-based bonuses, retirement perks, and stock sales. Number 1. WorldCom. MCI overstated assets by $11 billion, costing 30,000 jobs and investors $180 billion. Internal audit found $3.8 billion in fraud. Bernie Ebbers underreported line costs by capitalizing instead of expensing and inflated revenues with phony accounting entries. 25 years for fraud, conspiracy, and fraudulent documents. The CFO, controller, and corporation filed for bankruptcy. In less serious cases of fraud, Ratley explains, the offending numbers are modified or wiped off. With a case this massive, they were destined to get discovered, but in many other fraud instances, it's ignored. Al Genie, chairman of the management department at Loyola University Chicago's Quinlan School of Business, says it's about leadership. No one should be trusted. Even if someone seems fine and has risen through the ranks, C-suite candidates should be scrutinized. Directors should do this. It isn't symbolic. Loyola's Baumhart Center director John R. Boatwright agrees. When I teach this case, I show students that Ebbers was overmatched. His past experience didn't qualify him for the job. His background wasn't CEO-worthy. His business approach was an expanding stock price. A qualified CEO wouldn't allow it. Brad Sargent, CPA/CFF, CFE, CFS, CR.FA, FABFA, and Insight Forensics Insider columnist, disagrees. In hindsight, he argues, these senior executives perpetrating frauds look like selfish crooks. They earned riches, power, and influence via hard labor, diligence, and determination. Nobody intentionally committed fraud. They made ethical mistakes that led them, their organizations, and their stakeholders to commit crimes. One person utilizing one set of accounting entries can't commit $1 billion fraud overnight. It takes years to co-opt an organization's whole leadership structure. Like this video? Tell us below. Subscribe if you wish to hear from us again.